Good afternoon. Thank you very much. And this is a round that deals with U.S. pension funds investing in Africa. And my name is Raphael Stone. I'm a lawyer and attorney in a law firm in Seattle, Washington, Foster Pepper. And also on our panel here are Cheryl Austin, who's executive director of Dallas Retirement System, Nick Ferdsley, who is president of the World Pension Council, Joseph Boiteng, who's CIO of the Casey Family Programs, John Espinoza, managing director, TIAA Craft, and Kim Liu, vice president, co-chief investment officer, Carnegie Corporation of New York. A little bit of background about myself. I chair what is called an investment management group in our law firm. We represent approximately 32 public U.S. funds, probably the largest collection in the U.S., 6 of which are the largest funds in the U.S. We probably runs to approximately a couple trillion U.S. dollars. We primarily do their alternative investments, which includes private equity hedge, infrastructure, real estate that's globally invested. That being said, I agree with an earlier speaker who said that the percentage of U.S. funds invested in Africa is very small compared to the capital we have to invest. And it's unfortunate that they did not film our session a few minutes ago in the conference room, which was very robust, about why U.S. funds aren't investing more in Africa, and hopefully it will be a robust panel here. That being said, I do believe that there is significant interest by U.S. funds in Africa, investing in Africa. In May, I was a panelist with 10 large U.S. funds who were going through the ABCs of Africa, and it's hard to believe that as sophisticated as you think they are, that they wanted to go through the ABCs of what Africa countries there were, how many there were, what made up those companies, what their strengths were, et cetera. That being said, there was a couple $1 trillion of managers there, and CIOs, so obviously there's an interest. And this last year, I think we've invested $120 million in commingled funds in Africa. So there is interest. A couple years back, I could not have said that. So I will start off the first question to Cheryl Austin to have her tell us a little about the Dallas Retirement System, its international investment strategies, and what, if any, criteria she would add to potentially investing in Africa.
Well, thank you, and I'd like to thank African Investor for inviting me to attend and speak at the conference. And first, a little bit about the Dallas Employees Retirement Fund. I'm the executive director. The fund's been around for about 70 years. We represent $3 billion, $3.5 billion. And currently, when you look at our asset allocation, we have over a third that's invested internationally. So if you look at global equity funds, international equity funds, private equity, we have over a third that's invested internationally. But when I go and look at how much, and we select managers and we let them invest broadly. But when you look at how much they have actually put in Africa, it is a very small percentage. And so that tells us that we need to be more intentional about our mandates about investing in the region. And so just to kind of step back and what Raphael talked a little bit about was the U.S. pension funds, and just to kind of give you a little bit of the size and scale. So the top 300 U.S. public pension funds represent $15 trillion. It represents 43% of global pension assets. What's similar to some of the African pension funds, we have long-term liabilities. We have a very long-term focus. We're thinking 15, 20, 30 years investment horizon. And we are return focused. And I think that's very important. Our actual rate that we need to achieve, it varies for some between 5 to 8%. And so you might turn around and say, why all the interest in Africa? And it's simply the returns. I heard the earlier panel from the pension fund from South Africa talk about double-digit returns. Well, if you look at, and everyone knows that if you look at some of the current rates of return for some other asset classes, it's going to be considerably lower. So pension funds need to look at what are the opportunities to increase achieve those types of returns, high single digits, double-digit returns, long term. And so Africa rises to the top in that discussion. And so in order for us to get there, and we talked a little bit about this, a couple things. One is board education. It's the ABCs. I think a lot of the investment staff is aware, but we all report to a board. And so we need to make sure that our board is educated about Africa past the headlines. I think that's very important because they'll see the headlines and they'll think of it as, from a risk perspective, that it's a little bit too risky. But I think that people, that's one of the things, and what Raphael was talking about, the ABCs of Africa. The other thing I think is really the tools. We hire managers, and what we've seen in the last few years that may not have existed 15 to 20 years ago, we're seeing a lot of great managers, private equity funds who have feet on the ground in Africa, who understand the returns that we hope to achieve. And so I think that there are more ways or tools that we can use to invest in Africa. And so with that, I'll wind up my comments.
Thank you, Cheryl. There will be a drift here. You will notice that I will ask each panelist something about their fund and then what they think about and recommendations for investing in Africa. So the next person I will talk to is John. And John, would you tell us a little about TIAA-CREF and then your criteria and requirements for potentially increasing your allocation to Africa?
Well, thanks, Raphael, and thanks to African Investor for having me. And so if you give me maybe 30 seconds to just do the TIAA-CREF plug here and introduce you if you're not familiar with the firm. So TIAA-CREF is a global financial services firm. We have close to $900 billion in assets through not only TIAA-CREF Asset Management, which is where I work, which is about $630 billion, but also our affiliates Nuveen as well as Henderson Real Estate. So turning it to TIAA-CREF Asset Management, where we're very performance focused. We manage not only general account money, which is for our 5 million plus participants, offering them retirement solutions and retirement income, but also we have a funds business where 75% of our funds are ranked 4 and 5 star by Morningstar, and for the last 3 years we've been awarded the Lipper Award for best large fund family. So turning to Africa and where I fit into all of this. I head our emerging markets fixed income research team. Our EM assets under management is about 10 billion, and we invest globally in EM across local currency markets, sovereign markets in US dollar, as well as EM corporates. In terms of our Africa focus, first I want to highlight that in terms of our funds and our emerging market debt mutual fund, 10% of the index that we're benchmarked to is in Africa, and this is across Africa. South Africa is the largest country in that, but the index itself has about 60 countries and many countries in Africa. Compare that to where we were 5 years ago, where Africa was 5% of the index, the MB Global Diversified. It may not seem like a lot, but we're talking about total benchmark assets globally, at least the ones that are benchmarked and recorded by various banks like JP Morgan to be 300 billion. So 10 billion, 10% out of that is quite a large number. 5 years ago, Latin America was at 40% of the index. It's now closer to 35%. The Middle East has stayed stagnant, actually has fallen. It's at 4%. And even Asia, where we've seen an explosion in Asian debt capital markets, it still stayed flat in the last 5 years at 20%. So what does this mean for us and our team? What it means is that there is a greater opportunity set to invest in. Now, the challenges are that are many, and if you've been watching the news and and following Africa closely, as I presume most everyone here is, we're facing various both structural and cyclical, headwinds that our team is managing through, and the risks not only stem from commodity prices, where a lot of our countries in Africa are obviously commodity exporters, but we're also facing pretty sizable fiscal headwinds as well, where countries are having to many countries in Africa that we invest in are having to navigate twin deficits, fiscal deficits, and current account deficits. Mind you, there are obviously the other structural risks that we have to deal with and understand from institutions that are still pretty nascent. They're improving, their policy-making credibility, but there's still, quite a ways to go, as well as challenges in terms of liquidity. As most of you have been focusing on here, African currencies have been facing a tough time, and we have liquidity challenges not only from a convertibility standpoint, a trading standpoint, but also hedging limitations. So we have to manage through that. So that's kind of the risk side of the equation. To be a little bit more balanced, what are the opportunities? And the opportunities are certainly great. I mean, you have some key structural drivers, whether it be demographic, whether it be infrastructure needs that should hopefully be funded and fuel growth over the medium term, and provide for investment opportunities, but also the fact that because there are challenges to understanding, and by the way, I think our research team, we have a very deep fundamental research bench, which does a fantastic job, but nonetheless, even having that expertise and sending our folks to kick the tires, as I'm going to pretty soon, even having that, there are challenges over data quality, over governance in investing in certain corporates, so those challenges afford institutions like ourselves and asset managers like ourselves that have invested in a team, and an active team, to be able to identify maybe mispriced, misvalued, opportunities, and contribute to greater alpha generating, capacity. So I maybe we'll stop there and pass it to Raphael.
Yeah. Well, thank you, Nick. As you can see, when I was talking about our conversation in the conference room, robust, we went through a wide range of risk and if you will, positives. And so you will see that many of the panelists will have interesting views on how best to, if you're going to approach Africa from an investor's perspective, how to do that. And Joseph, I have actually, there are a couple questions for you. One being with respect to the Casey family program, a little bit about your history and track record investing in the continent, and what you think you'll do and need to increase your investments, one. And then two, what advice you'd give investors like our clients who are trying to enter the market and are just putting their toe in the water.
Okay. Thanks, Raphael. So as you can tell from my last name, I'm from Ghana, but representing KC Family Programs. So if you came here to get an autograph from the footballer, you're in the wrong place. But thanks, African Investor, for having me here.
Your middle name's not Prince?
No. Right there. So talking about Africa, I've been an investor in Africa through KC Family Programs for a long time. We've made money. We've also had some bumps, and we've learned from it. Net has been very positive. So I'd like to step back and address, my colleagues set the stage for some of the points that I'm going to talk about. Talking about KC Family Programs, you wonder what program is that? One happy, or one big happy family. I'm sure you've all seen the brown trucks which block your way in the morning with UPS on it. Yes. KC Family Programs was founded 50 years ago by the founder of UPS. It's a private foundation, it's an operating foundation based in the US, and its goal is to improve the well-being of kids or young adults in foster care. Yes, US has its own issues, and I didn't know about it until I joined this foundation. And as an operating foundation, it means we don't fundraise. Whatever monies we take in came from the founder, Jim Casey, who is passed on. So we survive pretty much by the investment returns that we make on the assets. Jim collectively and his family left about $7 billion to cater to the programs. $2.2 billion is what I directly oversee. And of this 2.2, close to $500 million is in emerging markets across the globe. As you can tell, we are not limited by geography. Wherever the brown trucks, ply the roads, or wherever the brown airplanes fly to, we like to invest in those countries. So that is how we go about our business. So we have a creative tension, i.e., in its truest form, we can only eat what we kill. And since I'm vegan, I don't eat meat, we only go for the substance. Over the past 10 years, out of this 2.2 billion, we've spent over 1.1 billion on programs, but we still have 2.2 and plus. So the point I'm trying to bring out here is that we can only eat what we kill. We can only survive on investment returns. Otherwise, you eat into your seed money. Herein lies the attractiveness of Africa. Those of you looking at, investment performance, or you look at various asset classes, and if you're looking for 7% rate of return, high single digit, but it's not that easy to get. So we went into Africa before it became a necessity to go in to make the numbers work. So even though it's a charitable organization, when we make an investment, it's not charity. Capital has choices. So when we go to the continent, it's a matter of you doing well, we doing well, because we have over 400,000 children to feed in America. And the way I encourage my investment managers is if you lose money, then I'll give you some children to take care of. Because we have real mouths to feed. So let's go to Africa. We are invested in all asset classes, from public equities, private equity, real estate, and also in the debt capital markets. From both North Africa to Middle Africa, as the EcoBank MD talked about, I like the way he categorized it, and also South Africa. That's the way we look at it. And I would say that the headlines, you cannot be comfortable with the headlines. Beneath the headlines is the opportunity. And you need to know the people you're working with. We talk about the rule of law, having access to data and all that stuff. Good on paper, but trust me, it can only help you up to a point. If you have to sue someone in court, you may get your day in court, but are you going to wait for 20 years? Are you going to wait for 10 years? There's cost to doing business. So you need to understand who you're doing business with. And everybody will claim, yeah, they know people can make things happen. You got to do your work. So by that, I mean you need feet on the ground. Drones will not work. I've traveled most of these countries, from Botswana, South Africa, Joburg, Cape Town, Angola, Ghana, Nigeria, name it. Because we need to understand the people we are working with. We have patient capital, and if you're deploying money on the ground for 10, 15 years, I need to know who I'm investing with. I need to know what we're invested in. I need to know how the value creation is all done. If you're relying on hope, trust me, there are churches around here, I'll go there for that. So we are there to make money, and you are also to make money. So what is the criteria? The opportunity, we see it in the headlines. African rising, African ready for business. That, unfortunately, will not pass the investment criteria in my investment committee. Africa is rising, so is Asia, so is LATAM. So let's get to the bottom line. What are the risks? We talked about some of them in terms of the shared geography, not that is closer, as far as I'm concerned, than Asia. So geography is not a limitation. We talk about bankability of, call it products. I haven't seen a standard definition of that, so maybe we need to get below the buzzwords and get down to the results, what gains we get from the investments we make. And I have to adjust it for the risk. The biggest risk for me is execution risk. It's not political risk. How do we call gridlock in Washington when you can't have any laws passed? That is also political risk. If your money is locked up, you cannot deploy it because you're waiting for clarity in policy, you're losing money indirectly. Execution risk, can the people deliver? Everybody presented with capital, most people will tell you they can get the work done. But the bottom line is that do they have the expertise to deliver the quality within the time that is expected? Most of this will go into the real estate infrastructure where you're taking development risk. Can that GP on the ground deliver? If they can't or you have problems, take your money and move on. I also need to be compensated for the risk I'm taking. I'm not talking about any mean variance, optimization stuff here, no standard deviation stuff. I'm talking about the risk of me losing money in the long run. One, I need a return of my capital, and I need a return on it to justify the investments over there because I have real mouths to feed. Outperforming by losing less doesn't cut it for me. Again, relative outperformance, if I want by losing less to not feed the kids, and we have folks here to feed. So if you take the risks, for me, execution is key. The quality of the people, the human capital, access to the markets. Again, feet on the ground, someone in London just flying in, flying back, writing good reports, again, doesn't cut it for me. We want to have that handshake. We own those investments, and that's the way we like to approach it. Just one quick word on public equities. On public equities, what I prefer and what we've done is to give global mandates and give our managers the latitude to invest in the countries they choose to invest. And they've done very well. Net, I've made more money in the developing countries, Africa included, than the developed. And that is what has funded the 1 billion plus in programs without tipping into the seed money. But it is hard work, and like I said, we all have our bumps and stripes, and we learn from it. We use the negatives to develop the positives, but it is hard work, and the headlines just doesn't cut it. Question to Rafael, we can come at specific questions.
Very good. Nick, talk to us about what your take is on U.S. pension funds and our best options to invest in Africa.
Thanks, Rafael. First, I want to thank Hubert Denso for having put together such a beautiful roundtable. We are the World Pensions Council. We're a Paris-based international association of public and private pension funds. So our remit is more global, but of course we include North American and US public pension funds within our members. I want to start answering your question by building on what Cheryl said earlier. And she mentioned that roughly the sum total of assets owned by American public pension funds is equivalent to roughly $15 trillion, right? Mm-hmm. And that is 39 or 40 or 42% of the global AUM of all pension funds worldwide. So that's a huge figure. And up north in Canada, it's even more impressive because I think the GDP of Canada is 12 times smaller than the US. But if you look at the Canadian federal, provincial, and municipal public pension schemes, they represent 20 or 22% of the total AUM of the US. So that adds another, let's say another 3 or $3.5 trillion. And then if you add to that the UK, if you take British pension funds, that also adds another 5 or 6 trillion dollars. So what I'm coming at is, if you take the US, Canada, and England, if you take only public pension schemes, broadly defined, that's nearly 60% of the total AUM of all public and private pension funds worldwide. So that's a lot of money. So by focusing only on that narrowly defined group of investors, if these people in Ottawa, Washington, DC, New York, Edinburgh, if they increase a little bit their exposure to African assets, that can move tens of billions of dollars fairly rapidly. So I think it's, in terms of advocacy, preaching, lobbying, it makes sense to talk to them first and foremost. And so I would really have, I would really stress that point. I think it's very important. And a second point that I would stress is that, of course, there are many asset classes. And without, playing the devil's advocate, I think, the least liquid asset classes, which are also the smallest in terms of assets invested, which would be, private equity, venture capital, or infrastructure, in Africa, they really represent a small percentage of the money invested by US public pension schemes. The vast majority of American public pension money going into sub-Saharan Africa and North Africa is going into bonds, of course, as John mentioned earlier, or listed equity. And really private equity, venture capital is really below, and infrastructure, what we call real assets, is really much smaller. Now the advantage of investing in infrastructure and private equity and venture capital in Africa is that it frees you from the biases of the benchmark. And of course, don't get me wrong, we suffer from the biases of the benchmark on Wall Street. So by being close to the S&P 500 or the Dow Jones, you are being biased, but it's even worse in sub-Saharan Africa. So the impact of the benchmark, if you're buying listed equity, is terrible in Africa because it forces you mechanically to be overexposed to just 2 or 3 countries. So you think you're Pan-African, and in reality, you're buying South Africa, Nigeria, and Egypt, and a little bit of Morocco and Kenya, and in many instances, that is your supposedly so-called Pan-African listed equity portfolio. Now this is the norm, but thank God, we also have the exception to the norm, which is that some pension funds and some asset management companies, which are not the rule, but they're in the minority, they take the liberty of moving away from the benchmark. And that is not common. So in most instances, the trustees, the administrators sitting on the board of the pension funds want to play it safe. So you have trustees, politicians, labor unions. They're kind of conservative. They don't want to take too much risk, and they would kind of tell the people running the mandate, stick to the benchmark, because in the US they're used to it, and they imagine that in Africa the same kind of investment procedure will work. Of course, it doesn't, and I was speaking with Kim and Joe literally as we were moving into that conference room, and I was pleased to learn that for the listed African equity mandates that they have, they take the complete opposite view, and they have an anti-benchmark philosophy. So they give their managers a huge leeway to move away from the benchmark, not to be prisoner, quote unquote, of South African, Nigerian, Egyptian stocks, and really have a broad geographic and sector exposure. And I think that's a great thing. If I had one recommendation to make is like, if you want to stick to the benchmark, you may as well buy an ETF or a passive tracker. If you're going for active African investment, be bold and really move away from the benchmark. I think that's something which is key. And one more point, and I'll conclude on that, is like there is more risk, of course, in buying private equity and infrastructure, but it is the future because beyond these short-term headwinds that John referred to, and of course we all see the pictures on TV of these riots, and we all see the prices of commodities going down. But not only Africa, but Brazil. Brazil 6 days ago you had urban warfare in the middle of the most expensive part of Rio. So that can happen in Indonesia, in Brazil, not only in Africa. So these headwinds are there. They're like short, medium-term headwinds. I think the African story is a long-term story, of course, and you have demographic variables, sociological variables. So all the stars are aligned, and the long-term story in Africa is a beautiful story. And if you want to play that long-term story, you should play it across all asset classes, bonds, listed equity, real estate, yes, but also a little bit of private equity and infrastructure. I think diversification across asset classes, across all asset classes, is true in all markets, and all the more, I would say, in sub-Saharan Africa.
Thank you, Nick. And our next speaker is going to be Kim, and you might want to build a little on what Nick was saying about your company.
So I'm gonna give you a little background on Carnegie, because I feel like that we're a little different, even than Joseph, although we're also a private foundation. I always feel like private foundations are somewhere in between pension funds and high net worth individuals, because we are founded by an individual, but we have sort of an institutional quality to us. So unlike Joseph, who has actual mouths to feed, we are only a grant-making foundation, so we're not an operating foundation. And we are the oldest private foundation, started by Andrew Carnegie, just to give you a sense of just the magnitude of what Andrew Carnegie's wealth was. And he founded 22 different foundations. We are the largest and the one that he headed at one point, but
He founded TIA-CREF too?
he founded TIA-CREF too, at Sesame Street.
Sorry.
And a number of other organizations. But just to give you just a sense of the magnitude of the wealth of Andrew Carnegie, in current day dollars, his wealth would be about $309 billion versus everybody talks about Gates at $136 billion. So just the magnitude of his wealth was tremendous. His mandate was 3 different programs. It was education. He felt like you need to if people had the ability to pull themselves up by their pull themselves up by their bootstraps if they were able to educate themselves. So education, he was an immigrant. So he believed in you should come to a country, you should immigrate, you should become a citizen. So we have a democracy program, and he was anti-war. So we have a peace program, and we continue to have those 3 programs. So I just give you a little sense of that and the difference between sort of Joseph, where he actually has mouths to feed. We focus on really big issues. And the benefit of focusing on big issues, in my opinion, is that our expenses are much more variable than Joseph's are. He can't say to a kid, you can only eat breakfast for the next year and you can't eat breakfast, lunch, and dinner because we lost money. Whereas I can say to the people we give grants to, we're gonna have to cut back a little because the endowment is down. So our expenses are highly variable. The only thing that's fixed is the cost of running the foundation, and the cost of running the foundation is relatively small. So we're required to give away 5% of our assets, but it's whatever our assets are. That's what makes it variable, plus expenses, plus whatever it takes to run the investment function. So because we have highly variable, flexible expenses, we run an equity-centric portfolio, a very highly equity-centric portfolio. And we're able to handle the volatility just because of what I described. And so when we look at things, we always look at it compared to a public market alternative. So to give you a sense, we've been investing in Africa specifically since about 99, 2000. And right now, we have about a little bit more than a third of our overall portfolio invested in Africa, all through public equity markets. And we have about 15% of our overall portfolio in 15% of our overall portfolio in emerging markets. So the fact that we have 3% in Africa means that Africa is a pretty substantial part of our emerging markets portfolio. I think the difference between when we first started investing in Africa and now is it was a beta play before, right? You know, we made money just because we made a decision to allocate to Africa, and other people were not willing to allocate to Africa, and we made money on that. It is not a beta play anymore. It is an alpha play. And manager selection and stock selection is highly important, to the point that Nick made. And so people's strategy before could be, I'm just gonna invest in Africa and that would make a difference. And so increasingly, we focus a lot more on what the opportunity set is, where we see the potential to make money, and then we compare all the different opportunities. So right now, there's an increasing push for people moving who had traditionally done public equities to look at private equities because there are more levers of change there and there are more opportunities. But for us, when we look at public versus private, the private market has to outperform the public market for us to invest in it, because if we're gonna lock up capital, it's gotta be because we think that we have a better opportunity to make money. And so we've stayed focused on the public markets because of the way we invest in public markets. To Nick's point, we don't invest in the benchmark. We give our managers are benchmark agnostic. We tend to do really small companies. We don't tend to have a lot of commodities, almost no commodities with our managers, which is different than most Africa managers. And we have banks, but we don't tend to have the same banks that are in the benchmark because of the fact that we give them the latitude to look for inefficiencies. As a result of that, it captures a lot of the things that people are going after in private equity, but without the lockup. And so we have focused. We still believe very strongly that Africa is a good market. We've invested in, like I said, we've started in '99. We've invested along the way because we think there's opportunities. We actually think the opportunities are going to be greater over time. When we first invested, there were a lot less developed managers who had experience, who had been doing things in the market. Now there are tons more qualified investors with strong infrastructures who have been there and done things and worked through cycles. But there's a lot of capital right now in the private markets, and it's something that concerns us. And so we spend a lot of time figuring out if the amount of capital is just too big for the opportunity set there, which gives us some pause. But that said, we believe pretty strongly that Africa is going to continue to be a great market to be in over the long term. And like, we are over 100 years old. We expect that someday we'll be 100 years old. And so we try to invest for that long term. And so we see Africa, the continent, as a place that will provide opportunities over a long term. So we continue to look at it.
Thank you, Kim. And I know we're running short on time, so I'd like to throw it out to the audience for any questions you may have of this panel, which is really an outstanding panel. So any questions?
Just one question, maybe for Nick or anyone who can answer it. You talked about the ladder of investments and the infrastructure, so direct infrastructure play being somewhat at the bottom. Does anyone have any examples of where you've gone down to that level and been successful of direct plays in infrastructure?
We don't invest, we're like an association of asset owners, but I can tell you what I'm seeing from some of our members. It's really early stages. So there's more talk, there's much more talk of pension fund and sovereign fund investment in sub-Saharan African infrastructure than real deals being made. It's really embryonic. And what I would say is the following is only the very large public pension fund can afford to do it because it's highly illiquid and it's difficult and it's complicated. It is interesting, of course, and it's potentially very much rewarding because if you look at an infrastructure asset, an ideal infrastructure asset, so let's take a highway, a toll road, or some rail tracks, or some utility companies. On the one hand, it looks very much like a bond because it's generating every week, every month, every quarter, some kind of yield, which is similar to what owning a fixed income instrument would give you. Yet at the same time, in theory, risk-adjusted returns, even taking into account the relatively high risk, the country risk that you have in Africa, they're interesting returns. So there's a compelling case, you can show it using an Excel spreadsheet, etc. Compelling case in favor of more investment in emerging market or even frontier market infrastructure. In reality, it's more complicated because even if you look at infrastructure in the US or the UK, which are mature, sophisticated, low-risk countries, we don't see as much infrastructure investment by pension funds as we should. And if you look at Canadian and American pension funds, where is the bulk of their infrastructure money invested? Well, it's a lot in the UK. So they prefer buying rail tracks and utility companies in London than doing so in Indiana or Ontario. So a lot of that money is going to London. A lot of money is going to Australia. And so one of the reasons why a lot of infrastructure investment by pension funds is not going to emerging market or frontier market, but going to Australia and the UK is that the rule of law, you know, fiscal efficiency, the fact that if you're unhappy with your partner and if the partner happens to be a municipality or the Ministry of Public Works, you can take him or her to court and have a quick resolution of the case. That, of course, is very difficult in most jurisdictions, all the more in Africa. So one of the reasons why people like the UK and Australia is they view the court system as being very quick and efficient, and they view the court system as really being fair to the outsider, even more so than the court system, let's say, in New York City or Montreal, right? So to conclude and answer your question, I think the easiest, the logical path for more public pension fund investment into sub-Saharan frontier markets would be co-investment jointly with supranational institutions such as, the World Bank, the European Commission, the Chinese government. So all these, the recently founded, AIIB, the Asian Infrastructure Investment Bank, which was incorporated in Beijing, I think 7 weeks ago. They have amongst their founding fathers and founding mothers many African governments, and they have said that in 2016, 2017, they will put money on the ground, not drones, but on the ground in Africa. And the Chinese have announced that they would love to co-invest jointly with American and Canadian and British pension funds. So all the stars are aligned. It will take time. It will take time. And I think Hubert here himself, one of the many hats he wears, I think is advising the Mauritius government, right, on that issue. So you're seeing things happening everywhere, including in Mauritius, Madagascar. People are starting to do their homework. It will take time.
We have another question here.
Thank you very much. I'm about to go to a meeting which is investment committee of an institution that I am on the board of, and I'm looking at their report, and I think Cambridge Associates, they talk about the first half of the year, first part of the year, returns, and every sector of the market is down with the exception of Japan. So I'd like to ask you, what is your outlook for emerging markets in general over the next 18 months? Because we have very smart money around the table. And what's the outlook for Africa returns?
Well, we were discussing that in the conference. Who wants to take that on?
I'll answer it. We tend to look at a very long term. 18 months is way too short. Otherwise, I'll be trading, I'll keep it in cash. So if you're looking at, some of these classes like investing in private equity, emerging markets, you have the headwinds, the dollar, confidence, slowing down in global call it trade, or you talk about the commodities meltdown, is the super cycle busted? I think 18 months is way too short, and that's part of the problem that we face, trying to even come out with predictions for the next call it 3 months, or the quarter by quarter. Sometimes it becomes an obsession. It doesn't help the committee, neither does it help the investment staff. And the twist to it is that you have, consultants coming up also with long-term capital markets returns, 7 to 10 years, out, and they are revising it every 3 months. Again, that doesn't help anyone either. So that is my 2 cents on that.
And
I know it's supposed to be ending, but the story is compelling. We know that pension funds, in particular in the U.S. and other industrialized countries, have a large ecosystem of consultants and fund managers in different vehicles. So if you were to advise Africans about how to do their roadshows more effectively with that whole ecosystem, what is it that needs to be done? Which parts of the ecosystem need to understand the opportunities? You talked about risk mitigation through co-investment. What do they need to do? Where is the cell need to go to, and how to make it with what kind of compelling information?
Very good question. Go ahead.
so I think that's actually a very good question. If I can just take a step back and I'll get to your question about roadshows, but I think it's also important to put into context that within Africa, just 5 or 10 years ago, I remember that emerging markets itself was not a core asset class for either public pension funds or just asset managers. It was very tactical and opportunistic. And now you look at any kind of product shelf out there for asset managers, and they will have both a debt strategy as well as equity strategy in emerging markets. So I think that putting that into context, I think going forward, it's an evolution. I focused on Asia for many years and see many of the challenges as well as opportunities in Africa now. So going forward, I think it's quite possible that we could see it become more of a core, region for cross-asset investments, not just what I'm involved in, but across the board. But to answer your question about roadshows, because not only do I, but all the other folks on my team, whether it's on the research side or portfolio management side, go to these roadshows. And whether it's sovereign issuers or corporate issuers or bank issuers, we have a lot of that visibility, with teams that come from Africa. And definitely it's, I think, I don't have a kind of consistent evaluation. I think they're all kind of across the spectrum. You have the South Africas, of the world, where you have their treasury team. They come, they're very experienced, they're very sophisticated. They've been doing this for a long time. But keep in mind that a third of their local bond market is held by foreigners. They have a free-floating, exchange rate. Convertibility is not an issue, so they're very used to this. And their corporates and banks also. And then on the opposite side of the spectrum, you have some recent issuers in the sovereign bond market, like in Ethiopia, which has traditionally been a very closed economy and not very open capital markets. And what we see is, in terms of that evolution, is you start out typically with a sovereign bond issue. You get your policymakers and your team trained, by bankers, being able to anticipate questions from investors like ourselves, making sure that you get a rating, from the rating agencies, so that your debt is more easily understood, and there's research, broadly available, and we think those are kind of the building blocks to eventually get from, some maiden, issuers in the sovereign debt market to where the South Africas are of this world.
I think one of the things I would add specifically is, one of the things I see is that there are big differences between LPs. LPs are looking for different things. Some people are really driven by return. Some people are really driven by asset allocation. Some people feel their expertise is in manager selection, while others feel it's in asset allocation, right? So knowing what there's a shoe for every foot, but not every shoe fits every foot, right? And so you hear oftentimes people come and they'll pitch a story about, this is my Africa story. And that may be true, but that's not what I'm looking to buy, right? But there is LPs out there who are looking just for that. And so I think there's a lot of investors who waste a lot of time, of their time and their resources. It takes a lot of energy, I know, raising capital. And it's time you're spending when you could be investing. And so the upfront work you do to make sure that the thing you're selling is the thing that the LP is willing to buy is time well spent. And you may be offering things that are right for more than one different LP, but make sure the story you're telling is the right one. Because some people really feel strongly about diversification. They're investing because they feel like this is going to offer them opportunities when other parts of their portfolio are not, especially in this world where we're increasingly hearing that there's convergence and there's not a lot of diversification domestically, and so people are looking outside for that. That's a story some people want to buy. Some people are absolutely looking at the growth story of Africa, and they want to hear that. But the type of return they're looking for is high because they're buying a growth story. So know what they're buying, make sure you can deliver that, and don't waste your time with people who are not trying to buy what you're selling, because it's really not a good use of your time.
One thing I would add on the public side, public pension funds, is just like you said, the variety of funds out there is just tremendous. And so understanding in terms of who you're talking to and what they need as a pension fund is really critical, and who they rely upon. You mentioned gatekeepers. And some funds, if you're talking to big funds, they're going to all have gatekeepers. And their job is to say no, unless you can show us why. And so in terms of meeting with them, you've got to really come prepared. You've got to have a team, you've got to have a history of this team, even though you're an emerging market from an emerging country. Still you've got to show that we've been together so many years. We've got so much experience. because, you know, we're really looking at that person across. You talk about that team that we're really looking at, because that's where we're putting our money. And then there are some funds who the CIO is going to be making the call, and not the gatekeeper. So to a certain degree, you've got to do your homework and know who you're presenting to, and then how to get into that, if you will, the right person or the right group that's going to make that decision. But in almost all cases, you've got to show that the team out there that you're putting our dollars with is a solid team in the sense of some type of years together. They've worked together. It's not 5 people who've just come together last month and said, we have an idea. And so you have to show you've done your homework and show you've got a package and be able to present that in a very logical, business-like manner. And I don't know if I'm answering your question, but a lot of what I'm saying I think is common sense. That's how, from our client's perspective, because in many cases we assist on the due diligence. That's how you have to go about doing it. I think we're there on our time. We really, maybe not real. Can we have one more quick question?
Just as a follow-up, thank you for that. Question is, we have on one hand incredible interest in Africa. You have U.S., certainly money around the table here, willing and interested in coming. You also have U.S. businesses that are looking for business. So what I don't see here is a synergy between the two of you, because you talk about the team, somebody talk about capacity building. So, for instance, Côte d'Ivoire will be releasing about $66 billion worth of planning for the next 5 years. And we always meet with US companies. They come along. What if you can all talk together here, bring the expertise with the financing, and then ask government, what are the securities that you provide for our investment to be safe? Because we know the partners that we're dealing with. I mean, I don't see that synergy. What are you doing about that?
You raise a very important point, i.e. the investors, the financial investors or the pension funds and endowments, their goals might be different from the strategics, the company. If I'm operating company deciding to go into Cote d'Ivoire, Ghana, Nigeria, my considerations might be different from the institutional investor that is coming in for all kinds of reasons. It could be ESG, it could be the returns, it could be I don't know, they could have other reasons. So getting the synergy here among the investors before coming is a very hard one, because our goals are very different. Even on the institution side, very different. So it's a matter of how these opportunities are pitched, or how the roadshows are targeted towards the ultimate investor, be it the strategic or be it the institutional investor. Because in most cases, there's also a cultural thing which has to do with it. I've talked to people on the ground, and to the extent that you're used to receiving aid and you meet with someone, you have private capital to deploy. Meanwhile, they're talking about CDC, DEG, FMO, and it's like, great, good to have that. But this is private money that needs to make money. Different set of considerations from maybe an UPS making a direct investment, over there. But I hear you on the other side, it could be very confusing on your side. So our approach is to be on the ground, talk to the people, explain how we're different, how we evaluate these opportunities, and be ready to play if it makes sense to us. Because just being passionate, sometimes you meet folks, they're extremely passionate about the opportunity, but it may not address our needs. It doesn't go anywhere.
That's a very good question, and I know this doesn't help you, but in terms of alignment of interest, there is very little. And we do invest for different reasons. And so you just have to understand, and it is confusing, but there's very little alignment of interest among LPs. They're there for different reasons.
And I would just add, in the way that, look, Africa is it's not monolithic. The way we approach investing in Africa is very differentiated. While everyone sitting here, we're not a monolith either. We have, different mandates. We're charged to generate, sustainable, consistent investment outperformance for our participants, given our structures and our, requirements. What I would do is actually kick it to the countries and the fund and capital seekers, for them to provide, the proper environment to attract, investors like ours. Again, I go back to Asia where public-private partnership was, just a catch-all, term, a few years back, and it was used from places like Indonesia or India or the Philippines that really have massive infrastructure deficits. Yet, if you look at the capital realization, even putting together very strong PPP type of frameworks in place, it's actually underperformed. And I say this more as a cautionary tale towards Africa, that Africa has to, and the countries themselves and governments and policies have to set up the right policy, the right environment to attract, investors like ourselves that have very different focus and mandates.
And just a very quick point is I would say that if you look at big corporates from the US and as opposed to pension funds going to Cote d'Ivoire or Rwanda, I would say their interests in the short, medium term might be extremely divergent, because if you're a Colgate-Palmolive or Volkswagen, and if you want to go into Cote d'Ivoire or Rwanda, the calculation you make might be a 30, 40 years calculation, and you may want initially simply to grab market share, and you may be willing for 5, 6 years to lose money. A pension fund or an endowment cannot afford to lose money in Cote d'Ivoire for 5, 6 years. I think that's a big difference.
But I'm patient.
Yeah. Thank you very much.
Doing business in Africa. You can't afford to be without Africa Investor.